Hey, it's Jim, and this is FRM Part 2, the topic on credit risk measurement and management, and the chapter on an introduction to credit risk modeling and assessment. I'm hopeful that many of you are history buffs like I am, and you will have noticed in the first paragraph there's a mention that credit risk management goes all the way back to the beginning of civilization. So I started thinking to myself, did Julius Caesar worry about credit risk measuring and managing credit risk, what was that, a couple thousand years ago? I mean, after all, there were bankers back then. I think they were called merchants, and they did collecting, and they had tax collecting. And was there a famous dude who lived a long time ago who said something like, render unto Caesar what is Caesar's? Now, the next sentence in this first paragraph says something like, you know what, credit risk measurement and management has evolved quite dramatically in the last 2 or 3 decades. So I'm guessing that you won't have any questions on the exam on Julius Caesar, but you will have questions on that kind of evolution. So let's see what those learning objectives look like. We'll spend just a little bit of time on things that have shown up before. You would have seen this whole CAMEL system. You would have heard about probability of defaults, capital adequacy. So those first 3 learning objectives are a little bit of a review of what we've done before, but then we're going to get into these models. And that's probably the last 2/3 of this chapter. And that's where we'll have some really good slides, some really good examples. Excuse me, of course, you're going to have to memorize some formulas for those models. So let's get right into it. The beginning of this chapter goes a long way to convince you and me that credit markets have substantially grown in the last couple of decades. And so there are tons and tons of statistics. So I can't imagine that GARP is going to ask you some of these statistics, but I think it was just their way of convincing you that they can make this conclusion down at the bottom, right? Since this growth, we've got massive growth, so we need better tools than Julius Caesar used a couple thousand years ago to model credit risk. And we're going to take a look at some of those tools. So that's really the beginning. It's kind of like the setup to this particular chapter. Now, this first learning objective, I think, is really good, and it's really important. However, if you take a look at the reading, there's about this much that refers to the CAMEL system. In fact, they just list the first letter in CAMEL and expect you to figure out, explain, evaluating financial conditions of a bank. So here's my takeaway on this, that the beginning of this section mentions these, but there are lots and lots of definitions and applications and implications that we're going to use throughout this chapter and beyond in future chapters. One thing that you should probably be aware of, right? Each component is assigned a rating of 1 to 5. So 1 is the best, 5 is the worst. You might get a question on interpreting 1, 2, 3, 4, and 5. So there you go. There's a good gray box to help you with that. So let's go over each one of these variables inside of the CAMEL system to try to get a sense of what the CAMEL system does for us and how it's going to relate to, this evolution that is mentioned in that first chapter or 2. So the first one is capital adequacy. So this has everything to do with the financial institution's ability to maintain solvency. And so, we've talked about the Basel, the 1, the 2, the 5, the 10. What are we up to these days? Tier 1. So there's a total capital ratio that capital adequacy can be measured by. I think a good exam question would be, it can ensure, boy, I really don't like that word. How about we can say it increases the probability that the bank can withstand economic downturns. But the cool thing about the capital adequacy, the C part of CAMEL, is what we have over on the illustration. This is risk weighting. This is an important concept as we move through this particular chapter. And so just remember that if you own, let's say, a treasury security, what do we know? That depending on its duration, it might have some and substantial interest rate risk, but it's going to have 0 default risk. So that risk weighting, look at the top. Well, there's cash. So we're gonna say that's 0, right? We're gonna assign that a risk weight of 0. And then maybe if I came to your financial institution, you would say, all right, Jim, you're in your 60s. you have pretty stable income, stable job, you got a bunch of assets, maybe we'll assign a risk weighting to you of, I don't know, I'm picking a number here, 20%, 30%. And I'm not trying to pat myself on the back there, by the way. But if my older son comes in, he just started his career, he has no assets, right? He has some kind of income, but who knows how stable it is. You might assign that to, I don't know, 40 or 60 or 80, maybe even 99 if you had a conversation with my son. Of course, I'm just joking there. So this concept of risk weighting is super important as we move through this particular chapter. But note that riskier assets, they can have a weighting of greater than 100%. So this weighting scheme, kind of adjusts the financial statements. I mean, in particular, the balance sheet. And instead of saying like, okay, we have 100 in loans to the government, we have 100 in loans to Jim, we have 100 in loans to Jim's son, so we would sum those and we'd say we have 300, right? But if we weight them by their risk, we're probably going to have less than 300 because that's kind of like I don't want to call it a realizable value, but it's something that relates to, what can we sell that particular asset for? Asset quality, this has everything to do on the left-hand side of the financial institution's balance sheet in terms of the ability of all of those individual borrowers to repay their loans in terms of the entire portfolio. So we want asset diversification there. And that should make perfect sense. I'll give you a quick example. Over this recent January 1st, my wife and I traveled to her home state. And her neighborhood was almost totally wiped out by a tornado a year or so ago. And it still looks devastated today. So my point is that, look, if we were a financial institution and we lent to all of those individuals in that neighborhood and it gets wiped out, well, my gosh, what the heck do you do with that? So asset diversification doesn't simply mean something like, okay, let's lend to the government, let's lend to Jim, and let's lend to his son. Each of them have different risks, so we'll assign a different risk weighting like we just did, but let's make sure that we diversify over all different ways of diversification, including what I just mentioned, geography, including currencies, and including loan type. So lots and lots of diversification there. And then, of course, how do we handle these? Let me go back here real quickly. So if we have these riskier assets here down in that bottom circle, some of those are going to default. So how do we handle that? So non-performing loans, we do ratios. We worry about how much are we going to write out? What are our loan loss reserves? And then, of course, the value of the underlying collateral. So asset quality, management capabilities. I think the good exam question here would be, all right, let's go back to the board of directors. Remember what I've said to you many times before, that the board has essentially two functions: to establish the strategic direction of the financial institution, and then to hire and fire the executive leadership team. So this management capabilities has its roots inside of the board of directors and the quality of the board. I mean, if the board has high quality individuals, highly skilled individuals who are committed to being good stewards of the strategic direction of the financial institution, well, then they're going to do their best to hire and fire effective bank leaders. Now, the implication there is that we're going to do some audits, we're going to do some compliance, we're going to make sure that we have a plan for succession, not only on the board, but also in the executive leadership team. This thing here can be summarized, and we've talked at length about this in other chapters about this, operational risk. And this is, kind of the human component of that operational risk. All right, let's switch over to the income statement. What's the most important word there? Look at that third diamond point, sustainability. I say this all the time to my students. What's the goal of the business? Maximize shareholder wealth. How do we do this? We find positive NPV projects that have sustainable and high operating cash flows. And the same, of course, is true for financial institutions. So look at some of those words that we have bolded up at the top, reflects quality, right, and quantity and trend. So we want the upward trend. We want them sustainable, of high quality. So what's implied in there is that we don't have lots and lots of standard deviation. derived from recurring sources. Now, that's a little bit of a challenge there because, as a good financial institution, we want to make sure that we always lend to those people who are going to repay, and then we assign an interest rate to that loan that's reflective of, this kind of entire credit risk measurement and management system that we're talking about inside a handful of these chapters here. But we also want to branch out. Maybe we want to branch out into derivative securities. Maybe we want to branch out into global lending. Maybe we got all these kinds of things. So the focus then is that recurring sources. Think of that as the core business, right? The brand name. That's what that is. Liquidity. Look at all of the boxes that we have over on the right. Cash reserves, liquid assets, coverage ratios, the interbank borrowing market, the funding markets. And so we're going to have all sorts of liquidity ratios here. Remember, this really just is a sense of short-term ability to have sufficient short-term assets to meet those short-term liabilities. Ideally, you have short-term, and we can even measure in the short-term duration. We could say, 28 days, let's say, on our liability side, and we want to match over here on the asset side. We want to have those assets mature when those liabilities are due. So this is the whole matching stuff that we've talked about before. Now, also in the bottom, we can include diversification here of funding sources. What does that look like over on the right-hand side of the balance sheet? And then that CAMEL system, that was developed long time ago, but then we added an S to it sometime in the last decade for sensitivity to market conditions. So these are things like COVID. Right? What do we have that? That's been a handful of years now. Things like, the market crash from in 2008. But how can we do these kinds of things? Well, we've had conversations before on stress testing. We've done value at risk. We're going to do more and more of these fun things as we get through some more chapters inside of this topic. So look at the bottom there. This is a great exam question. Asset and liabilities, these values, they change. And so we want to make sure that we know what the duration of the assets and the duration of the liabilities is so that we have a better chance to match. Now, having said that, I will say and remind you that the very next sentence, after this very short sentence in the beginning of this chapter, sounds something like, this is an old, outdated system, so we need something better. And that's what we're going to do for the rest of this slide deck. Now, I spent a little bit of extra time here because the concepts of the CAMEL system, they're applied to all of these other things that we're going to do. So you might not have a direct CAMEL system question. You might, but you might not have a direct one. But you'll clearly have an indirect one on how these inputs and how these variables affect, kind of these new and evolved systems. Now, this is where I think it gets super interesting in terms of being able to identify potential exam questions. So it's very clear inside of the chapter, and I'm going to skip ahead here a second. So watch this, 1 out of 3. So there's strategic uncertainty, there's occasional uncertainty, and there's cognitive uncertainty. So these are really great exam questions. So imagine, I could just right off the top of my head, I could make up 6 questions where I have 6 different question stems, and strategic, occasional, and cognitive uncertainties are the 3 or 4 answer choices. I could throw something else in there for that 4th one. So you're going to have to know all of these definitions. So these are really, really good potential exam questions. So how about this strategic uncertainty? This has everything to do with the relationship between the borrower and the lender. The borrower and the lender, they have different goals, they have different agendas, and they very likely have different information sets. So that's what that middle column is, adverse selection. When I was in graduate school, my finance professors called it adverse information. And we always talked about the floor of the New York Stock Exchange. There's a bid and an ask price. And so you got these 2 traders, one buying and one selling. And if one of those parties has more information about the value of the underlying asset, like a share of stock in, let's say, Procter & Gamble or Johnson & Johnson, well, then that trader, whether that trader is on the buy or the sell side, is always going to win in the long term. And so this, of course, applies to the borrower and the lender inside of a financial institution. And so if I have this idea, if I'm a businessman and I have this idea for a very risky product line, I'm going to go to the bank and say, hey, can you lend me all this money? And the bank says, well, sure, maybe I'll charge you a little bit of a higher interest rate. But I know better than the bank does what my chances of success are. And if my chances of success are, let's say 10%, the bank may assign me an interest rate that might be 20%. So there's that adverse selection. I'm drawn to that. And the interest rate may not match. It might match if the financial institution is on top of this and just adds some kind of an adverse information or adverse selection premium in that building blocks model that's pretty much a standard model for determining the interest rates. On the other hand, moral hazard, I'm going to go ahead and give you the Jerry Seinfeld example. Those of you who are Seinfeld fans remember that Jerry went to he went to rent a car. And he got up to the counter and he said, I have a reservation for a car. And the agent said, I'm sorry, we ran out of cars. And he said, well, you know how to hold the reservation, but you don't know, that whole Seinfeld thing. It was so funny. And then she asked him, would you like insurance? And Jerry says, oh yeah, I want the maximum of insurance because I'm going to beat the heck out of this car. So Jerry, now of course in a comedy sitcom, this thing here doesn't play out exactly like moral hazard, but Jerry had this idea that, they were cheating him or they were not fair with him. So he was going to crash the car or whatever it was. So that's the moral hazard. Riskier behavior from those borrowers. So this, this pushes those interest rates up, which increases, the chance of insolvency for the financial institution. Occasional uncertainty. Look down at the bottom. Occasional meaning that these things are not regular events. So these can occur on the macro level. So skip down to the bottom, like I said, natural disasters, economic crisis, drastic political changes. But then skip up to the dollar sign. These are micro occasional uncertainties, job loss, emergency, financial needs. So think about occasional uncertainty. External factors, we have that written up at the top. And what these lead to are, kind of short-term. Can I say short-term? I mean, essentially, hopefully short-term uncertainty surrounding the repayment of some kind of a loan. You figure in the long term, you can recover from a job loss. You can recover from a tornado. You can recover from a hurricane, although maybe not. I have a good friend who lost his house in the most recent hurricane in Florida, and he packed up, sold the land, and moved back to his hometown. So he's back with us now. So that's kind of more permanent. So this occasional uncertainty, don't be so influenced by the time element of this. Just be ready to answer a question on what we have in bolded there. That should make perfect sense. And then cognitive uncertainties. I'll give you an example. When my father was alive, he claimed to be very perceptive about things, but he suffered from lots of biases. And one of them was a hindsight bias, and I'll explain that here in just a second. We have kind of a little suburb that is outside of our town where they were constructing lots and lots of townhomes. And my father would say something like, who in the heck is going to buy those townhomes? Because they were like $200,000, $220,000, which seemed pretty high to me back in those days. And sure enough, this was like 2007, 2008. And then we had the financial crisis and we had the, residential mortgage crisis. And my dad immediately said, see, I told you, I predicted that thing. And so this is all about this cognitive uncertainty. So you have individuals who think they can go into this townhome for $220,000 and they figure, oh, you know what, something good will happen to me and I'll be able to repay that. It'll be my income will increase or I'll have an inheritance or something. And then the financial institution, kind of piggybacks on that because look, they're making lots and lots of these loans. Maybe at higher interest rates, but those interest rates are probably not high. So look at the second gray box point we have there, irrational financial behavior. I think that's probably the good exam question inside of this. So let me just go back here real quickly. So make sure you know the definition and the implications of these three types of uncertainties. All right, let's move on to the bulk of this here. Let me go back to this learning objective, right? We need to do probability of default, loss given default. So here's a slide here. Now, the chapter does not give us any kind of an example here, but I'm going to give you a quick one anyway. So I'm guessing you remember this from old time days, maybe before previous recordings, or maybe your undergraduate days. Probability of default. It's the chance or the likelihood or the probability fails to make payments in full and on time. So remember those two components about the probability of default. And then there's the exposure at default, which is the risk exposure at the time of default, and then the loss given default. So look at the expected loss equation down there. All we're going to do is we're going to multiply these three, the blue, the red, and the purple boxes together to get something called an expected loss. So probability, that's a decimal. Exposure at default, that's another decimal. And then the loss given default is a dollar amount. So we're going to multiply those two decimals by $1 to get the expected loss in terms of $1. So let me give you just a quick example. Let's suppose that I come to you and I want to borrow $100, and I'm going to repay that over time, whatever that time period is. And so you look at all of my assets and my income, and you come up with a probability of default of 20%. Let's just pick a number. So you're tempted to say the expected loss is going to be 20% of that $100. Now that's going to be true in an extreme case, and we'll see that here in just a second. But if you take 20% times 100, you get an expected loss of $20, right? But that is not the true expected loss, given the fact that you have some ability to attach my loan to maybe a piece of property, maybe some other kind of collateral, maybe some asset that I have, or something. So what we need to do to get the true expected loss is to multiply by that extra amount that reflects the recovery rate. So what did I say just a moment ago? I owe you $100. Probability of default is 20. So let's suppose that I default, but you can sell my collateral, whatever that collateral is, for 90. All right, so you get 90. So what does that mean? So your loss then, I owed you 100, your loss, you sold it for 90, so your loss is only 10. So your loss is only 10%. 10 over that 100 is 10%. So that's how we get the expected loss. So take the probability of default times, probability of default, what was that, 20, times the exposure at default, which was just 10%, times the loss given default, which is the $100. So there you go, whatever that number turns out to be. So you're saying instead of the $20, now it's just $10. I'm sorry, now it's just $2, right? And that's what we have down at the bottom. There's that recovery rate, one minus the recovery rate, which is the way I presented it to you there. So I'm not quite sure that you should be ready to come up with that exact number that I did. However, you should know the definitions of these and how they relate to things like recovery. And that has a lot to do with collateral and has a lot to do with computing that probability of default. Now, that loss given default is kind of an interesting thing. In my example, it was an easy one, right? But suppose that you're a financial institution and you have a credit card out there, and I'm your credit card holder. And so what can I do? You calculate this thing, but then I go use my credit card again, and then I use it again, and I use it again, I use it again, so that sometimes you might think that these input variables are relatively easy to compute, and sometimes they are in my simple original example, but sometimes they're not. Now, the last part of this learning objective has everything to do with the time horizon. So notice that in earlier slides, I used the term duration. So we have the maturity date of the loan, but we also have the duration of the loan. Remember, the duration is the first derivative of the price yield relationship. And so that duration for an interest paying loan is going to be less than its maturity date. So of course, longer time horizons, they increase this thing that we talked about in the very beginning. What did I say? Interest rate risk. And so what happens then is that these longer time horizons are going to increase that uncertainty. Here, let me just go back here. Whether it's this one, or this one, increase those uncertainties. So that's potentially raising the probability of default and leading to higher exposures at default. And so I think the good exam question here is, all right, let's go back. We know these variables here. We know these types of uncertainties here. I can even keep going back to the whole CAMEL system, right? So we know all of that stuff. The question then is, well, look at the bottom, right? Can lead to decreased recovery rates, lower values of the asset and collateral, economic changes, reduced market liquidity, all those things that we mentioned inside of the CAMEL system. You see how that CAMEL, even though they said something like, it's not really relevant these days, but the components of the CAMEL system are super relevant. And that leads us to this capital adequacy ratio here. So we're going to put capital in the numerator, and we'll talk at length about what kind of capital that we put in there. Remember, we had a definition for capital under Basel I. We had another one for Basel II, and then we have another one for Basel III. So these things change all the time, but we're going to divide by this concept of a risk-weighted assets, which was introduced to us by that CAMEL system. Now, the capital, there's tier 1 and tier 2. We know this from just our regular old knowledge of the Basel people, but I'm guessing that you ought to know this since the chapter does mention, that minimum capital adequacy ratio is set at 8% of those risk-weighted assets. Now, how do we calculate those risk-weighted assets? Well, we can use the historical approach. This is the standardized approach. This is the one-size-fits-all approach, which you guys probably know better than I do working in the financial institutions industry, is that this doesn't work. But nevertheless, these are predefined risk weights that can be applied to little old Jim's Bank here and to SV Bank, I've used that one, or to, big Gibraltar Bank, whatever that big bank is out there. And so, it works okay. Probably works better for the bigger banks than it does for the smaller banks. But notice in that second bullet point, straightforward, uniform application, easy implementation. I'm not so sure about the word easy implementation, but there are all sorts of issues that come up inside of the diverse universe of different types of financial institutions. So look at the bottom, cannot be tailored. So that's big. That's the problem there. So what do? We take the things that we like from that standardized approach, and then we do an internal ratings-based approach. So what we can do is we can say, here are these standardizations. So we like these standardizations, but what we want to do is we want to have the flexibility. So we'll call this the foundation. There's the F. And what that allows us to do is to determine the probability of default based on the individual borrowers. So like I come in, you assign me a probability of default. My son comes in, he gets a different probability of default. Hopefully you guys are smart enough to assign a much higher probability of default to my son. But then what we can do is use this standardization and use the parameters from the standardized approach to say something like, look, what we're going to do is we're going to make the tailoring, right, the customization at the individual loan level and even at the portfolio level if we choose to do that. And that's all part of the job of the chief risk officer as outlined by the board of directors. But then we can use this advanced, actually the reading calls it the asymptotic internal ratings-based approach. That term asymptotic means that you have some limit. You always bump your head up against the ceiling. A lot of times that ceiling is infinity. And so this allows for tons and tons of flexibility so that you can develop these internally. Now, some banks might not have the experience or the technical skill to identify loss given defaults inside of their financial institution so that you can use the standardization, but other banks do. So there's the difference between the two. That's a great exam question. Remember the foundational one or advanced. You don't have to remember asymptotic. All right, let's move to, here, watch this. We're going to have some judgmental approaches. We're going to have some data-driven approaches. And then we're going to have some financial approaches. So that's what we're going to do for much of the rest of the slide deck. Oops, I went back one too many. All right, the judgmental approach, of course, this is exactly what you would expect it to be. What we're going to do is we're going to say something like, hey, you know what? We're really, really smart. We have lots and lots of experience. We've lent to not just hundreds of thousands of individuals and businesses and economic agents, but we've lent to different types of individuals and institutions and businesses and economic agents out there so that we have this experience. So we're going to use this experience, use our judgment. That doesn't mean that we're going to ignore things like a statistical model. It doesn't mean we're going to ignore things like value at risk. No, of course, we're going to use a combination of qualitative and quantitative analysis, and we're going to focus on the credit analysis that we perform on each of these individual borrowers. Now, this judgmental approach is not going to use any of these super complex models. We're just going to use the regular old models. Maybe we'll use that CAMEL system. Maybe we'll adjust it a little bit. Maybe we'll throw in a little bit of the empirical and the financial models that we're going to use here in just a second. But we want to be simplistic, right? So that's why we have analytical simplicity in that middle column there. And then the emphasis is on the qualitative characteristics. So we use a little bit of math, but a lot of science. We use a little bit of math and science, but we use a lot of artistry. Our judgments, our experience, our ability to look somebody in the eye and say, I believe in you. I believe that you're going to make this work. Now, of course, we did the 5 C's. Actually, there used to be 4 C's, but then they added a 5th C. We did this in a previous chapter here inside of this topic. So I'll just mention these quickly. Character, capacity, capital, collateral, and conditions, right? These sound a little bit like they're related back to the CAMEL approach, and of course they are. So this 5 C's of credit, these are super important to be able to apply some type of a model to each individual loans. This really works for project finance. It works in special sectors where we can be experts in those sectors. Expert insights, we have that. What are limitations? Challenges in updating it. It doesn't work well when we have to assign a value to credit analysis that are complex, that are intertemporal in nature, that revolve around lots of different kinds of things. Yeah, plagued by transparency and consistency problems. Yeah, efforts to integrate analytical capabilities. Yeah, so this is what I was saying just a moment ago. We might try to use some of these models, but if we don't dive full-blown into those models, we might not be able to extract as much clear thinking as we want. That's why that clear thinking, that relates back to transparency. It relates back to validating the quality of the assets. So then the next step, of course, is to go ahead and turn off our emotional side, our judgmental side, and say, all right, what has happened in the past? Let's go all the way back to the time of Julius Caesar and say, what was their default rate in the year 400 BC? But I wonder if there's anybody out there that has that kind of data. Somebody has it somewhere, or you could just make it up. So what are we doing? Data-driven empirical analysis. We're looking at historical loan data so that we can identify these relevant and appropriate and forward-thinking variables that are going to support future credit assessment. You know, look down on the bottom right over there. Statistical models, machine learning, artificial intelligence. I mean, any kind of a model that's going to help us. Here, let me go just back here real quick. Can I go all the way back here? Yes. Any model that's going to help us compute the probability of default more accurately, and that exposure at default more accurately, and even the loss given default more accurately. So effective with large data sets. Of course, you don't want a sample size that's this big. You want a sample size that's huge. Yeah, what are the key features? What do we like about this? Less subjective. Of course, what did I just say? We're going to remove or try to remove the human element here, which means that we're not going to have the bias that my father had. You know, he had the hindsight bias to be able to say, oh, it was obvious to anyone who drove by those townhome complexes that there's just not going to be enough people around here to pay $220,000. We can scale this to small or big financial institutions, and we can apply these consistently throughout the scenarios. Here's the limitation. This is the big one here. You've heard me mention this before in previous recordings. We look to the past. Does that mean that we're going to have a perfect replication of the past? Now, of course, this is based on the simple idea that history tends to repeat itself. And I'll just repeat that again. History doesn't tend to repeat itself. History repeats itself. You know, how many times do we have to have a residential mortgage crisis for us to say something like, you know what? You know, let's go ahead and stop doing all these dumb things that we're doing to prop up home values, to, you know, for whatever those reasons are. Everyone seems to benefit when home prices rise, but whenever they don't, then everyone seems to fail, right? All right, so data may have imperfections, backward looking. They might be static. It's tough to update these in real time. Let's move on to financial models. And of course, this is going to be the most fun for me in this slide deck, because we're going to use option pricing theory to come up with some kind of a value. And you'll see all that in just a little bit. We're going to have to get out our calculators, so make sure you have those handy. What's the definition of these financial models? So what we're going to do is focus on financial principles, which has its roots in economic principles. So we're going to extract data from financial markets. We're going to take a look at bond prices. We're going to take a look at option prices. We're going to take a look at treasury prices. We're going to do all sorts of fun things. The cool thing about these financial models is that you can value something like a callable bond. You know, a callable bond has a call feature plus option-free component to it. So there's tons and tons of applications here. So look down at the bottom table. We have differences between structural models, which are called structural models because they look at the capital structure of a business. So think about the relationship between the assets and the liabilities and the equity. As opposed to the non-structural models, which for some reason are called reduced form models. Reduced form simply means that they might not have a predetermined form. They can be kind of anything that you want to throw into the model. That's why under theoretical framework we have statistical methods. So you could have 1,000 different variables to do some form of regression analysis. Now you're probably not going to have 1,000, but you can reduce it to one or two. Remember, when we have these conversations on regression analysis, you don't want to have too many variables, right? You want to have just the right number of variables, and that just the right number might be just one or two. So we'll talk about the Merton model down under structural. We'll talk about CreditRisk Plus and the CreditMetrics model as we go through this. What do we like about these? What are the advantages? Quantitative rigor, forward-looking analysis, customizable, market-oriented. Those make perfect sense. You'll see, you'll see exactly that application here in just a few minutes. Some people might think that they're too complex. I don't happen to think that is true. They are assumption sensitive. The Black-Scholes-Merton option pricing model makes some kind of an assumption that stock returns follow a nearly normal distribution. Let's call it a log normal distribution. But what happens if stock returns follow a distribution that looks like this? I don't really know what I'm doing with my hands. Well, then you have to throw this model completely out. And like many financial models, they are intensive with costs. These things are not cheap. Think of a Monte Carlo simulation model that runs all night long to try to determine whether there's an arbitrage opportunity in the euro, US dollar, and Canadian dollar market. This takes up tons of resources, and it's not cheap. So there's a picture of these three dudes, Fisher Black, Myron Scholes, and Robert Merton. They developed the Black-Scholes-Merton option pricing model. And then what Robert Merton did, and that's why it's called the Merton model, is that he just used the BSM model and applied it to this structural form. And so this is really, really cool. It's one of the most fun classes that I have in my corporate finance class. When think about a business's balance sheet. You got assets over on the left, you got liabilities on the top right, and think about those liabilities as a bond issue. And then you have equity on the bottom right. And so this is what Robert Merton decided, and this is back in the 1970s. He said something like, the equity position in a publicly held company is really a call option on the assets of the firm. So what happens? When a firm issues a bond, what it's doing is making an explicit promise. I promise to pay interest, I promise to pay principal to the bondholders. Now the bondholders lent the capital to the executives to buy these assets. So what's going to happen then is that the bondholders then have a claim on those assets. It's like they're the owners of the assets. They're part-time owners of the asset until the bond is repaid. So on the maturity date of the bond issue, the executives or the leaders, the shareholders have a decision. Do we pay off the bondholders and take sole and full possession of the asset, or do we default and let the bondholders worry about the asset? So let me go ahead and repeat what I said just a moment ago. Owning the equity in a corporation is exactly like having a call option, buying a call option on the assets of the company. And we're going to work through some examples, so you'll see this here in just a minute. All right, so here's the structural model. So the value of the equity, the value of the option to the shareholders is really just the difference between the market value of the assets. Notice we have an A sub T, firm value, at the debt maturity, firm value. That's the market value of the assets. That's the aggregation of all of the net present values of all the product lines of a business. We'll just subtract out the face value of the debt. And so the value of the option to the shareholders is going to be the maximum of, if that number is positive, or if it's negative, then it's going to be zero. So what happens? If that number is positive, say A minus L is positive, what the shareholders are going to do is exercise the option, pay off the bondholders, and take full possession, full ownership of those assets. If that A minus L is negative, then the shareholders default. They decide not to exercise their option. And they say to the bondholders, you can have possession of the assets. You take full ownership of them. You go ahead and sell them for whatever you can. Now, of course, this is a really cool way of looking at how a business operates. It's not a fun way, right? We don't want the shareholders to allow the option to expire, because then we go into bankruptcy. And then if this is in the financial institution industry, then we have to worry about contagion. Then we have to worry about the federal government. We have to worry about extra regulations coming in. All right, so what are these assumptions in this Merton model? Well, the same thing as they were in the Black-Scholes-Merton option pricing model. Forget about dividends. Single liability. So we've got this one matzo ball of a bond issue that matures at some time in the future. And in most cases, this is just going to be a zero coupon bond. I mean, you can throw coupon payments in there. It just complicates the matter just a little bit unnecessarily and without too much value. So think of a balloon payment at maturity, single liability. We'll go ahead and use the risk-free interest rate like we do all the time with the Black-Scholes-Merton option pricing model. And there are a variety of reasons that we use the risk-free rate of interest, not least of which is that I could show you that you could own the share of stock and you could write an option and you can generate a risk-free rate of return. So you have to think of this in the context of a portfolio. You see how this all works in the history of finance? This is why I'm such I have such tremendous interest in history. You know, you go back to Harry Markowitz, 1952, taught us all about standard deviation. And then William Sharpe in 1964 taught us about capital asset pricing model and the value of diversification and how to price that systematic risk. And that just flows right into the Black-Scholes-Merton option pricing model and to this model as well. And then there's that assumption that we have that stock prices follow this log normal distribution, which means stock returns follow kind of a nearly normal distribution. I said that before, but this is the assumption in purple that some people don't like. We need to throw in some kind of measure of standard deviation, and so we assume over the life of the mortgage or the life of the loan, whatever it is, that we have constant volatility. Now, this is not going to be on your test, but we can relax that assumption, and there's some more complex models. Maybe that's for another test. Maybe there's a part 3 or a part 10 or a part 12. Now here's the Black-Scholes-Merton option pricing model. This is the Merton model as it relates to the market value of equity. So there we have in that top diamond point E, the market value of the equity. Now this is a call option. It is equal to, now remember, there's an A right there, just like we had back here. Right at the top, there's an A, and there's a minus an L. So we're using this basic model right here, the value of the assets minus the face value of the bond issue. But what we're going to do is we're going to adjust them in two ways. We're going to adjust them by volatility. So there's an ND1 and there's an ND2. I'll tell you about those here in just a second. So that is going to be a probability weighted adjustment. So let me go back here. We're going to multiply A by a probability. We're going to multiply L by a probability. And the probability of L is going to be a little bit less than the probability of A. And that's just the way it works. And I'll explain that in more detail here in just a second. So think about this model here. We take A multiplied by a probability minus L multiplied by a lower probability, okay? And then we have to adjust L for time value of money. So we raise it to the minus RT, which means we're just taking the present value of the principal amount of the bond issue. All right, so let me go back here. In that equation, we have a measure of risk-free rates. We have a measure of distributions. We'll see that in a second. We're throwing out dividends. We have one liability. There's the L. And then we have constant volatility. So what we need to do is we need to figure out what ND1 is and what ND2 is. Now, remember what I just said. These are probabilities. So they're going to have a range of between 0 and 100%. Well, before we can compute a probability, we need to calculate a z-score. Now, Black-Scholes-Merton, they were aware when they did this model in 1970, they were aware that the notation Z had already been taken by the statisticians going back to the time of Julius Caesar. So they picked a different letter. They picked D1 and D2. But make no mistake, D1 is it's a Z distribution. So all we're going to do is have 3 components to compute this D1. And by the way, you're going to have to calculate this on the exam. So you need to memorize this formula and these equations. I tell my students this all the time. I say, look, if you work through the BSM model 5 times by the time the exam rolls around, you ought to be able to apply it. Now, I give them the formulas on the exam, so I'm being a little bit generous with them. You're not going to have these formulas, so you're going to have to memorize this. So I'm telling you that if you do this 5 times, you'll have no problem with this on the exam. All right, so you ready for this? Let's break it down into 3 components. We've got a top left, a top right, and a denominator. Forget about that huge formula there. It looks like it's just too cumbersome to remember. But let's do this. Let's break it into the first component, which is just A over L. So the market value of the assets divided by the par value of the liabilities, right? We're going to take the natural log of this to get a rate of return. So that's really just a rate of return on, let me go back here. So if you do A minus L, you get some number. If you do A minus L divided by A, you get discrete compounding return. If you do it this way, you get the continuously compounded rate of return. So think about that natural log A over L as a continuously compounded rate of return on the intrinsic value of the option. And the intrinsic value is just A minus L. Forget about everything else, okay? Then what we're going to do is we need to add the time value element. You guys know this, even before you were listening to my recordings, that the price of any security, including the value of equity here in this example, is a present value. So this is what we're going to do, time value here. So what we're going to do is we're going to take the risk-free rate of interest and we're going to add half of the variance. Now this half is nothing more than the result of taking first derivatives. So let's just leave it at that. Those of you who are mathematically inclined, you could just type in derivation of the Black-Scholes-Merton option pricing model, and you'll see how this works, but you probably don't need to worry about that for the exam. So all we're doing is we're taking the risk-free rate of return and we're adding some type of a return based on volatility, right? Standard deviation squared, that's the variance. So we're taking an interest rate and adding a variability in an interest rate, and then we're just multiplying it by time. We're adjusting it by time. So what do we have in the numerator? We have the continuously compounded return on intrinsic value plus the continuously compounded return on time value. And then we're going to divide that by the standard deviation. But notice, and I think I've said this to you before in previous recordings, we know that standard deviation moves through time at the square root. So we're just adjusting the standard deviation by the square root. So I promise you, if you think of top left, top right, and denominator as 3 separate components, memorize them as 3 separate components, then you'll be able to get D1. This is the big challenge on the exam, because once you get D1, then all you have to do is subtract the denominator to get D2. And therein lies the reason why probability, let me go back here, ND2 is going to be less than ND1. Notice there's a little bit of an equation there for volatility of the equity. That has to be given to you on the exam. All right, so let's go ahead and work through an example. Current market value of the assets, 500. Face value of the debt, 300,000. All right, so just in regular old finance accounting debits and credits terminology, you've got 500 in assets, 300 in liabilities, and 200 in equity, right? So that's our accounting thing. That's our accounting interpretation of those numbers. But those numbers don't consider time value of money or volatility. So here we have 20% volatility and a 5% risk-free rate of return over a 2-year time horizon. So here's the question. Go ahead and compute the market value of equity. You ready for this? Now, what did I say to you? If you can be through this 5 times. All right, so start your memorization today. Look at that thing, top left, top right, and bottom. So what are we going to do? We're just going to take the natural log of 5 over 3. And you don't need to put all those zeros in there, 500 over 300. Just do ln of 5 over 3, right? And give yourself that number, whatever that is. Then we're going to add 0.05, make sure you do decimals here on the right-hand top side, 0.05 plus 20% squared divided by 2 adjusted by time, which is 2 years. So you got a number on the top left, number on the top right, and then the bottom is pretty straightforward down there, 20% of the square root of 2. So there you get a D1 of 2.3 and a D2 of 2.02. I'm going to go ahead and say, hey, pause the video right now. Make certain that you can get those calculations. This will be your first time, and we're going to have another chance to do it inside of this slide deck. That'll already be your second time. You only need 3 more times. Boy, I sure hope I'm right on that estimate of 5. All right, you guys pause and make sure you can do those calculations. All right, welcome back for those of you who went ahead and paused that. Notice there was only like a second segue in there. So what we need to do is those, and let me go back here. Those two numbers, the 2.3 and the 2.02, those are exactly like the Z values and even the T values that you calculated back in your stats days and that we computed for value at risk. And we do a whole bunch of times here inside part 1 and part 2. So we just need to look these numbers up on the table to get the probabilities. So there you have it at the top. N of 2.3 is 98.93%. N of 2.02 is 97.83%. Notice ND2 is a little bit less than ND1. So all we do is extract those. Wait a minute, I'm going to go back here to life is simple. What is life simple? Here's this simple model. We're just taking the difference between the assets and the liabilities, right? So in our example, what was that? 500 minus 300, that's 200,000 from an accounting perspective. But now, when we use the Black-Scholes-Merton option pricing model and we apply the Merton model to equity as a call option, well, we consider volatility, right? And we consider time value. Look. Clearly the 0.2 squared, there's volatility. Clearly the 0.05, there's an interest rate. Clearly the 2 for 2 years, there's time value. So in our simple math, we got 200,000, but with using this complex, oh my gosh, wait a minute, let me go back and remind ourselves. What are we? We're in this structural model, right? We're in this financial model. We're using advanced techniques, advanced statistical techniques, advanced financial techniques to come up with $229,089. So there you go. There's a great exam question. If I'm making up this test, I'm having 10 of these questions on the exam because they are so much fun. Now, those of you who are paying attention, you might say to yourself, wait a minute, Jim, I don't want to do just, let me go back here. I don't want to do just 500 divided minus 300 to get 200. That face value is in 2 years. So let me go ahead and discount that. So here, I'm going to get out my calculator. You guys do this, right? But turn your calculators on. I got to take my glasses off because I can't see. So let's just take the present value of the 300. You ready? 300,000. And let's just do it simple. Divided by 1.05 equals, and then do it again, divided by 1.05 because it's 2 years. You get 272,000, right? 272,102. Subtract that. Oh, I need to put my glasses out. Subtract that from the 500,000. Well, you don't get the 229 exactly. What do you get? Some other number. That's pretty close to that. But so if you use just regular old time value of money stuff, you get, what was that number I got in here? 227. This one is 229. This is more accurate, right? This is more complete. It's based more on some extra variables like volatility. So this is really such a cool model. So let me just remind you what's going to show up on the exam. You have to have a question stem that includes these 5 variables. And the question is, calculate the market value of equity. And so you might be tempted, if you hadn't had any experience in option pricing, you might be tempted to think of, boy, there are some other models out there, maybe like the Gordon growth model or the free cash flow model or some other comparative model out there. And then you think volatility, I never did that in those models. Risk-free rate, I never did that in those models. This is really cool. I mean, this is like high five. We should be high-fiving each other. This is like, you guys watch basketball, you guys watch women's college basketball. This is the Caitlin Clark of college basketball. All right, what did I say earlier? We're going to go ahead and use this model to do some other stuff. So let's go ahead and see if we can use this model to come up with a better estimate of that probability of default. What was that first example I gave you when I came to you and I borrowed $100 and you looked at me and you said, hey, Jim, 20%, right? Well, let's use this Merton model to come up with a better estimate of the probability of default. Now, two cases here. You need to be very sensitive to the question stem. If we're going to use risk neutral probability of default, risk neutral simply means that investors are indifferent to risk. They only care about return. They don't care about risk. So all we're going to do is worry about our underlying assets growing at the risk-free rate of interest. So that probability of default, all we're going to do is compute D2 and then take 1 minus it. That's why we have the N of a minus D2. If we use the true probability of default, what we're going to do is we're going to use, here, let me do this back here. So here's our equation. Look, there's D1. Notice we have an R in the top right. Well. All we're going to do now is substitute the R, and we're going to substitute in for the expected return on those assets. So this is like the expected return on the positive net present value of all of those product lines that are on the left-hand side of the balance sheet. But here's where you need to make sure you don't make this mistake on the exam. Instead of adding half of the variance, we're subtracting. And that's the big difference there. And that's going to give us our probability of default. So remember the two, risk neutral and the true probability of default. So let's go ahead and look at the example. And this is the exact same inputs that we have, but notice down at the bottom, the expected return on the assets is 7%. We're not trying to compute the value of the equity. We're trying to compute the probability of default. So we're going to do the same thing that we've done before. Let's do the true probability down in the purple. We use that same equation. We're substituting 7% in for 5%, and we're subtracting. And we're going to get 2.16. Now hold off on that calculation here for just a second. And if we do that, we get 1.54. Compare that to risk neutral probability of default, which is 2.07. So that's a big difference between those two. Once again, what does the Merton model do? It adds complexity, it adds value. So we're going to have a more accurate measurement of that true probability of default, which we can then use in those models that we talked about earlier. Now, this brings us to this really cool concept of a distance to default. And this thing is going to be measured in terms of standard deviations. So I want you to look at that equation right there. And you're saying, wait a minute, Jim, that looks just like this right here. The only difference is that the probability of default, we have to consult the table. Here, we don't have to consult the table. We're given this to us in terms of standard deviations. So here, oh, I'm sorry. I was skipping ahead to this one here. Forget about that for just a second. So here's don't tilt your head sideways. I don't want you to get vertigo. I'm worried about getting vertigo. Here we have time on the horizontal axis, and we have market values on the vertical axis. So what do we know about the value of our product lines? We know that they change, right? So they go up and down, up and down. And so this distance to default concept is really, there's a normal distribution. That's kind of a nearly normal distribution. So let's work through an example, and I'll show you exactly what I mean here. So ready? Same old thing. Calculate the distance to default. So now I want you to go ahead and pause the video and calculate that 2.16. So we did it back here, right? There was that. And so we looked that number up on the table to get the probability of default. Here we're going to get the distance to default. So go ahead and pause the video and compute that 2.16. This is your second time. Of course, maybe it's not your second time because you have similar numbers in there. But look, just pay attention. Make sure that you put in 7% and you subtract in that numerator over on the far right. Okay, welcome back to those of you who go ahead and pause the video. So look at the interpretation down at the bottom. What that means that this 2.16, that's kind of a buffer against default. So what we can do is that the firm's asset values, right, the net present value of all these assets, it can move 2.16 standard deviations, which will keep it above that default line or that default point. So you get the sense of how that acts as a buffer. Now, look, you should pause and take a deep breath and say, you know what, Jim, that was a lot of stuff that we just did over the last 20 minutes or so. But it really adds tremendous value to our understanding of what we're trying to do, not only inside of this particular chapter, but this entire topic on, credit risk measurement and credit risk management. All right, what don't we like about this? There's nothing that I don't like about it, but really I'm not the person that is making up these tests. So I would just say, hey, you know what? This is an awesome model. There are some issues to it, but its complexity, fails to capture dynamic socioeconomic interactions. Well, my response to that would be, well, what does? What model out there does? I mean, there are other things that you can do out there, but I would, these are right from the chapter, so make sure you know these limitations. We do rely on historical data, but here's the way that we can get around this. I promise you, and maybe you guys know this better than I do, that in the financial institutions world, here, let me go back here. Look at this. Look here. Volatility of the assets returns, that's 20%, right? Where do we get that? We probably looked at historical data. But the really, really smart individuals out there, they are using forward-looking standard deviations. I mean, if you knew what the standard deviation of anything was for the next month, you could be a billionaire overnight. So historical data reliance. So that's true, but there are models to look to the future. We try to simplify, input sensitivity. Yeah, this is a problem here. When you get to the extremes in the Black-Scholes-Merton option pricing model, the model becomes less and less accurate. We're very sensitive to the input. So if you go in and you put, what did we have? 5% for risk-free, 7% for the return on the asset. If you change that to 6 and 8, or 2 and 4, you're going to get wildly different answers. So we need to be worried about that input sensitivity. And then, like everything, there are behavioral issues out there. There are cognitive errors that we make up here in our brain because we're just not smart enough. And then there are emotional biases that we make with our heart or our souls. So that means that's the influence by human behavior there. All right, the learning objective asks us to look at the Merton model, which we did. So let's go ahead and look at these last couple of models. The next one is the KMV model. These are three dudes. I know the V stands for Vasicek. He's written lots and lots of stuff on interest rate models. I still teach some of my students whenever I do financial institution, the Vasicek model. But they had a firm that was taken over by Moody's. That's why it's called the Moody's KMB model. And I want you to look down on the fourth arrow point. This is the exact exam question that I would create. What did we say about the Merton model? Is that it assumed that stock prices followed the log normal distribution. Well, this model uses historical data to come up with an actual empirical distribution of default frequencies. That sounds an awful lot like a really, really good exam question. Now, what this model does, that Merton model, we were looking at how do we value equity as a call option on the assets of the firm. We can then find the equity value, and we can find the present value of the bond, like we did. And then we moved on to these other kinds of concepts. What the KMV model does is that very first arrow point, the expected default frequency. So it's updated, it's an iterative algorithm, estimate the current value of the assets and their volatility. So this was one of the big challenges of the Merton model. So this KMV model, it kind of updates it to consider those extra variables. So you might consider this to be, a little bit of a stronger model. I'm not sure that I would go that far, but some people might say. But look at the bottom there, default point, the sum of short-term debt plus half of the long-term debt. That sounds like another really good exam question. So what are the similarities here? option pricing, equity, asset, all that kind of stuff that we just did. What are some of the differences? There we go. Historical data for an empirical distribution. That's important. Defines that default point as the sum of short and half of long-term debt. Remember, over in the Merton model, we just had one balloon payment over there out at the end. And then this KMB model, it maps distance to default. Now, there is only a short paragraph about this KMV model, but there are lots and lots of really potential good exam questions. So remember that. So those were the structural models. So let's go ahead and move on to this CreditMetrics model. What we're trying to do here is we're going to assess the probability of default by comparing it with similar defaulted companies. So you get the sense that this is, what did I call these? Non-structural models. So we're just going to say, right, we might have a structure, but we're going to compare it to firms over there to assess the probability of default. So there's a transition table that will allow us to say something like, okay, today we have this probability of default. Next week, we have this probability of default because of all of these changes that are out there. So notice the purple up there, right? We're not just worried about the default mode. We're focusing on mark-to-market evaluation. How are we going to do this? Well, we'll look at Moody's. We'll try to figure out collateral values and recovery rates. We'll look at yield margins. We might even look at yield spreads. We might even look somewhere else. We might throw value at risk in there. There's all sorts of things in there that we could add. So this credit metrics model has 3 stages. So I think this is probably a good question. So think about this. Stage 1, reporting profile. So what are we going to do? We've got some bond issue or we have some loan out there. And so what are we going to do? We're going to just collect as much as we can from the issuing government body or the issuing entity or whoever that borrower is. And so we'll establish some kind of a framework. Now, think about this. So on the left-hand side of our balance sheet, we have, let's just say 10 loans and 10 bond issues, right? So what do we do with that? So we've reported all that. Then what we need to do is we need to figure out what is the correlation coefficient between and among those from the entire portfolio perspective. Now that's the step 3 here in this 3-stage kind of a process. Notice down at the bottom we have total volatility, but in between that, so I want you to think about the reporting and then take a step back and think about correlations and then what happens. And then over time we have an upgrade, we have a downgrade, and we have a default. And so think about your knowledge of credit default swaps and credit default swap baskets will really help you here. So think about those loans inside of a basket, inside of a different basket, or put them in any kind of a basket that you want. Correlations of individuals and different baskets between and among each other. So that if we have a bond over here that defaults, and then we have another bond over here that has all the similar characteristics, right? Letters of credit, commercial credit agreements, all those kinds of things. Well, then that thing is more likely to default. Probability of default probably changes, right? So in this stage, these are 3 different stages, but they kind of go on simultaneously, I think. So I would know those 3 stages for potential exam question. What are the advantages? It focuses on that default. We don't need a whole lot of data. We have our data. We can go back over here and we can scan the environment and figure out what's going on over there and inside of our business, right? Ease of use. What don't we like about it? Homogeneity assumption, right? Assumes credit grades are uniform. That's why I was saying about if this one defaults, this one is more likely to default. It's in that same bucket. How do we handle volatility there? So there's this fixed interest rate concern. So we're going to use our fixed interest rate calculation, and it's dependent on data. How about this last model, the CreditRisk Plus model? That first block up at the top, this is the exam question there. 2 primary credit events, bankruptcy or a bad credit condition. We'll go ahead and compute those losses there. We'll compute default frequency and probability of default. They talk about the Poisson distribution down there. They don't really talk much about what that means, but it's probably a little bit more appropriate for default events than normal distribution or any kind of another distribution. So remember Poisson and the plus sign. If you can equate those two, you can probably answer a question on the exam. So here we go. Get out your phone and take a picture of this slide. This is super important. Lots and lots of really, really good exam questions. I mentioned most of these things in here. So take the picture and keep this nearby so that you can refer to this regularly before the exam. All right, let's move on to the end of these learning objectives here. Let's apply this risk-adjusted return on capital. So we talked about this a little bit earlier, something related to this, right? We need to figure out what this economic capital is and how do we define a return on capital. Well, we'll probably adjust it. So that's what we're going to do at the denominator, right? So loan revenues in the numerator, capital at risk in the denominator. I'll do a quick example here in just a second, but this is really just the simple old capital budgeting internal rate of return model that we used, way back in the old days. So we're going to reject a loan when the risk-adjusted rate of return is less than the cost of capital. We'll approve it if it's greater than that bank's cost of capital. Here's a good formula for loan reserves, or loan revenues, You'll have to remember that. Take the spread, add in fees, subtract out any expected losses, and then subtract out any operating costs. And then we have to adjust it by tax rate. So 1 minus X is the tax rate. There's a nice section in the reading on duration and how we use duration to compute the change in the loan value. So this is exactly like we applied duration. We're ignoring convexity here. So all we're going to do is take the loan amount and we're going to multiply that by the duration, L times D, and then the change in interest rate divided by 1 plus the interest rate. What we're doing is saying, okay, the interest rate is such a number like 10%. What happens if it goes up to 10.25%? So we would put 0.0025 in the numerator there to get that change in loan value. Once again, this is just duration. We're ignoring convexity. For the capital at risk, we're going to use these unexpected loan losses, and we're going to use the same kind of an equation we used before. We're going to do the loss given default. We're going to do the exposure at default, but we're going to multiply it by some multiplier. We'll call this a risk multiplier that reflects the unexpected default rate. So that would be given to you on the exam. The question is, how do you come up with it? That's a little bit more challenging. We'll probably use some kind of an historical estimation, although some element of the particulars of the loan ought to be reflected in there. All right, let's do a quick example here. $1 million, 4 years, fixed rate of 12%. Suppose the interest rates can change by 2%, and there's some extra stuff in there. If the cost of capital is 3%, let's go ahead and get out our calculator. You guys can do these fairly quickly. So we get the loan revenues. Our numerator then is 3,500. Our capital at risk, we've got the million times the 4 in the duration, right? Loan duration 4 years. 0.02 divided by 1.12. So remember, in that denominator, that 1 plus I is not like the new rate. So we wouldn't put 1.14 in there or 1.1. We'll put the existing rate in that denominator. So you get about, that's about 70,000. So 35 divided by 70, that's around 5%, right? 4.9. So that's greater than 3%. So there's our decision rule to go ahead and make the loan. That's based on this little sliding scale. Where was I? Right here. Yeah. So you can see that this would be the green loan has been approved. Wow, take a deep breath. That was tons and tons of stuff that we did. I kept you for probably over an hour, didn't I? Hopefully you haven't fallen asleep. But we did lots and lots of really good stuff in here. Hopefully I streamlined what could appear to be a relatively difficult chapter. Hopefully you got lots out of this recording. So hey, thanks for watching. Thanks for your patience with me. Thanks for listening to all my stories. I had fun. Have a great day and good luck studying.